And I'm here with Impactive Capital's Lauren Taylor Wolfe, who joined me a couple of years ago as well. Nice to have you.
Nice to be here. Thank you.
Small and mid-cap, I guess, activism, fair description to a certain extent for our viewers to understand what you're doing. What is the opportunity space like in small and mid-cap, particularly given the long underperformance versus the large cap that we talk about so often on CNBC?
Yes. Sure. So the past couple of years since the rapid rate hike started in the second half of 2022 has been difficult for small caps. And that's because they have a larger percentage, 40% of the debt on corporate balance sheets of small caps is variable versus like 15% for large cap peers, right? The EBITDA to interest coverage ratio is much lower. So the rate hike cycle really extracted out of small caps more so than large caps. But if you double click into where Impactive focuses, we're focused on small cap value companies that have strong balance sheets that generate a lot of free cash flow. And extracting back over the past 50 years through those cycles, what you see is today the highest quintile of small cap companies, so these are high free cash flow generators, they are trading at the lowest discount, the widest spread to their large cap free cash flow generating peers, the largest spread, the likes of which we haven't seen since only 2 times in the past 50 years, in the late 70s and the dot-com bubble. So we think, we're not market timers, but we do think that it's bound to revert. Mean reversion is a pattern that we see in every market cycle, and we wouldn't expect otherwise today.
You know, I do wonder, though, from a market structure perspective, there have been a lot of changes. There are far fewer public companies these days. Do you worry at all about simply a lack of sponsorship in the marketplace? You may do your price discovery and find something, but if nobody comes along with you because there's no money linked to it, there's not enough the stock won't go up anyway. Is that a concern?
So we've had companies like take Asbury or Sallie Mae, companies that we've been working with behind the scenes for many, many years. Both of those companies over the past 4 years, they haven't had any multiple expansion, which is what you're alluding to, but they've compounded earnings. So Asbury has tripled its earnings over the past 3 years. Sallie Mae has doubled its earnings, and the stocks have followed suit without any multiple expansion. There is also what you've seen is there's been a dearth of M&A activity and capital markets activity. So in 2023 and 2024, M&A activity is about 30% below the 10-year average. That and the IPO markets, which have been fairly lackluster, right, very muted. Once the markets start opening up, once there's certainty around the rate environment, once boardrooms have more confidence in the private conversations we're having, or that there needs to be more confidence to make bold capital allocation decisions. When there's more clarity in the environment, I think we're going to start to see more and more activity, which creates a lot of opportunities for small caps. And I think, maybe it's after November.
There's going to be more clarity in the environment, Lauren?
I certainly
I feel like I've been doing this a long time, as you know, and you can say that at any point in any time.
I don't know that there can be less. Yeah, I don't know that there can be any less clarity at this point.
Yeah.
But in our conversations with boards, we speak to almost every one of our portfolio company boards. They want to go on offense. Their balance sheets are strong. They're generating a ton of cash. And the question is, should we retire shares because they're trading at 8 times earnings, or should we go on offense?
Well, what do you tell them? Actually, why not just buy back a lot of stock and shrink the float and, know.
So we've done that with Sallie Mae over the past 3 years. We've repurchased. We've really urged them to sell loans off their book to mitigate the impact of this accounting change. And they have freed up $2.5 billion of capital to repurchase half the company. And so over the past 3 years, they repurchased half the company. The stock has doubled. It's performed well. However, because we pursue a different flavor of activism, right? We are not looking for, we're not telling companies to sell themselves. We're trying to work with companies to be their best selves. So we're not pursuing a 20% pop. We're looking to make doubles and triples over a long period of time. And as we know, the market rewards patience. The market is a device for transferring money in return from the impatient to the patient. And returns are never linear, or they're rarely linear.
That's true.
And so what we can do with companies is, irrespective of the economic cycle or the market cycle or the rate environment, we can use the various tools in the activist toolkit that we have and come to the table to help them optimize returns.